I'm Susan Chabinsky with Morningstar. Model portfolios have gained traction with financial advisors, and asset managers have flooded the marketplace with options. Given their growing popularity, you may soon hear about model portfolios from your advisor, if you haven't already. So, what are the pros and cons of model portfolios? How do they work? And what do you need to know about them before investing? Joining me today to discuss all of the above is Jason Kephart. Jason is Morningstar's Director of Multi-Asset Ratings. Good to see you, Jason.
Hi, Susan. Thanks for having me.
So let's start at the beginning. What are model portfolios?
A model portfolio is basically just a recipe. Much like you would cook food, it gives you a list of ingredients. Those are your underlying funds. And it tells you how to put them all together. That's your asset allocation. And it'll also tell you how to trade it over time. But essentially, I always think of it, it's basically just a recipe for how to build a portfolio.
Now, why are model portfolios attractive options for so many advisors these days?
I think the biggest benefit for advisors is one, it frees up time, right? You don't want your advisor to spend a lot of time stressing over, is the Fed going to cut 25 bips or 50 bips? You want them working on your financial plan. The advisor also wants to work on growing their business. So outsourcing the investment management to, a well-known firm that is pretty good at investing and does that full time, that gives the advisor a lot of time to do other things that could really build more meaningful relationships with their clients and also help them grow their business.
So how do advisors access these models?
There's a lot of different ways. If you're at a big firm, there might be what's called a home office model, which if you're at like a Merrill Lynch would be the model portfolio offered to all their financial advisors and filtered down to clients. We've also seen a lot of growth in third-party models. This is models from asset managers that you're familiar with, BlackRock, Vanguard, American funds. So there's really those two main ways. Or an advisor can maybe build their own model portfolio for their practice and something that's scalable across their clients.
Got it. So outside of those home office models, what are some of the most popular model providers?
Yeah, the most popular one by far is BlackRock. They've done a really good job capturing the advisor audience and doing a lot of things like building a lot of support around their model. So regular commentary, regular market views, and it doesn't hurt that they've also done a really good job managing them. The performance has been really solid. We think they're really good. Other ones that are really popular are American funds. Vanguard has been very popular, which is kind of interesting because they haven't really made as many inroads in asset allocation with financial advisors as these other firms, because Vanguard's always been so focused on the end investor. But really, it's made a lot more inroads with advisors more recently.
That's interesting. So now, what types of investments are typically held in these models? Mutual funds and ETFs?
Mainly mutual funds and ETFs. We're seeing a lot more ETFs, and particularly active ETFs. When we look at the model portfolio database at Morningstar, 3 years ago, only about 100 models had even one holding of an active ETF, and now more than 1,000 do. It's a great way to get active management at a lower fee, and models, the other benefit of them is that they tend to be really cheap. And ETFs also make them more portable. Mutual funds, right? You're going to depend which platform you're on. You might not be able to get the same one on Schwab as you do on Fidelity, but an ETF you can kind of access through anything. So that makes it a lot more flexible, I think, for the advisor.
So Jason, what types of model portfolios are most popular with advisors and why?
The most popular ones are kind of your building blocks, like your core, your portfolio. Think of the 60-40 portfolio as kind of the starting point. So, we kind of call them target risk. They target a level of volatility for a certain risk tolerance. So they kind of run the gamut from conservative to aggressive. But we tend to see a lot of advisors focus on that core 60-40 type portfolio.
And then, walk us through some of these various allocation models, given that these seem to be the ones that are the most popular with advisors, right?
Yeah, they tend to be fairly similar across the board. There's only so many ways you could torture a 60-40 to make it different, but we do see a lot of variations. Some will use alternatives, some won't. Some are all ETFs, some aren't. Some are much more long-term strategic asset allocations that will only shift maybe once a year, whereas others trade more frequently 4 to 6 times a year.
Okay. So what now, outside of these allocation model portfolios, what other types of model portfolios are out there that advisors are using?
Yeah, you can really make a model out of anything. The sky's the limit, and there's very little barriers to launching a new model. You don't have to go through the SEC or anything like that. So we see a lot of product proliferation in the model space. But other things we see are income-focused models, all equity models, all fixed income models. Some even do all US equity and international equity. So you kind of Frankenstein together a bunch of different models to get one total portfolio. And you might even see all alternative models. So really, whatever you can dream of, an asset manager's probably already got a model portfolio for it.
Now, are all of these models off the shelf, or are asset managers also offering advisors any sort of customization?
We're starting to see a lot more partnerships and customization with like large RIAs or wirehouses, where they might have certain requirements, like to be on our platform, you have to have at least 30% open architecture, which open architecture means firms, funds that are managed by firms that are not the model provider. So if it was a BlackRock, you'd have to have 30% in Vanguard, Schwab, State Street, other ETF providers. And it's really just to make sure you're not only getting one firm's views in there. So there are benefits from that, but a lot of times it could be a little bit of window dressing. But in general, we are seeing more customization, though, I think. There may be a large RA that doesn't want to give up Will Danoff. So the model provider will say, well, we didn't have Fidelity Contra Fund in there, but for you, we'll put it in there and kind of adjust things around.
Got it. Got it. So what type of advisors are more likely to use these customized options? Is it the bigger firms?
I think it's the advisors who are more focused on like financial planning.
Okay.
They take more of a holistic approach to kind of the client relationship, and it's not really just dependent on the performance of their investments. And I think that makes stickier client relationships. And you're focusing on things like estate planning, your kids' college savings, charitable giving, all these other things where investment performance, we know no strategy is in favor all the time. So if the only thing an advisor has to offer you is investment performance, there's probably going to be a period where that doesn't look that good. And that's going to, could create some churn for both the client and the advisor, which is probably never a fun thing to do.
Now, what would you say are the advantages of model portfolios over other investment options for investors?
Yeah, I think one, they're usually like an all-in-one solution. They tend to be very low cost. A lot of the model providers that are the most popular are asset managers we think really highly of. We think really highly of the multi-asset teams at Vanguard, at American Funds, at BlackRock. So there's a lot of good investments out there for people. And it does also give you direct ownership of the underlying funds. So this is one advantage you'd have over using like a Vanguard model over a Vanguard allocation mutual fund. In an allocation mutual fund, you just own a share of the mutual fund. But in a Vanguard model, you would own directly the 4 or 5 ETFs that make it up. So that could create some like more tax optimization. You could sell things at a loss, lock in gains to offset future gains. So you just have a little bit more flexibility in the model space.
So then, Jason, what would you say are the disadvantages of model portfolios over, say, straight mutual funds or ETFs?
I think one of the disadvantages, there's a little less transparency around it. You can't really look up a model portfolio on Morningstar.com per se, like you could a mutual fund. If you are a user of Morningstar Direct, as a financial advisor, you can see our ratings and star ratings for models. But I think for the individual investor, there's a little bit of opacity there. So it's not as easy to look up like past performance, manager turnover. So you're going to rely on your financial advisor to do that due diligence for you. So there's a lot of trust there, I think.
So then what about some of the checklists that investors should have if their advisor is saying, hey, I want to start using model portfolios? One of them, might be, hey, ask to look at the prior performance, since it's hard to access that, right? What would be some other things they should be asking their advisors for before investing in these?
Yeah, I think maybe the first thing would be, are we using a model portfolio? Some advisors might not be as forthright to tell you the portfolio you're in is actually a model they're following. So that's one thing I maybe start with. I'd also want to know, how did you pick this model over other models? Maybe what other models did you consider, and what did you see the pros and cons of those to kind of get a flavor of how much due diligence was done? Then I think you want to know about the track record. Obviously, past performance is not indicative of future performance, but you want to make sure you're checking out that you're in something that has done well and performs like you think it should over different market environments. And I think the other thing to think about would be, well, how are you measuring success of this model portfolio? How do we know if it's doing well or not? Like, how are you going to measure that? I think those are the main questions I'd want to ask my financial advisor.
Well, thank you so much for your time, Jason. We appreciate it, and we'll be talking to you more in the future about other things that investors might be hearing about from their advisors.
Great. Looking forward to it.
Nice to talk to you. Thanks for tuning in. I'm Susan Jabinski.